Broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Mortgage Coach Annual Review. Today what we're going to do is we're going to look at a few different aspects. We're going to look at how to do the annual mortgage review, what's in it for you as well as other referral markets, as well as where do we start? How do we begin this process if we haven't been going through it? Before I get started, I always like to do a quick check-in. Make sure that you can see my screen as well as hear me. So if you can please let me know what company you're with, as well as where you're located. Type it right down here in this type question here area and click on that send button for me. Also, you will find in that same panel, the handout area located in the middle. There is a handout in there. That's the annual mortgage review handout. It'll say AMR PDF. This is the same presentation piece I'm going to use at the beginning of the presentation. You will want this piece because you'll be able to reflect back on it in order to remember what it was that we talked about. So welcome, Jim from Kansas City. I was actually born in Leavenworth. Nice to have you. Nice to have you, Jennifer, with Caliber. So we do have quite a few of you on the call. So if you have questions at any time, that same panel that you just typed in, this is going to be the panel that you'll also ask those questions. I will be going through the presentation first, and then at the end of the presentation, I will come back and answer any questions. I want to get through it by 5:30, and then if you want to stick around, we can go through those questions. Let's go ahead and get started. So annual mortgage review playbook, we're going to go through everything, but first I want to talk about why is your personal book of business important. This is your warm market. This is where 42% of your personal referrals come from. Also, if you don't build these relationships now, you're going to find out that you will have less and less business. The reason why is it's becoming so easy for people to go online and do it through a digital marketing experience. So if you don't have relationships built, if you don't have that strong foundation, it's more likely your business is going to be pulled by that online business as well. Remember, we are not in a sales business. This is actually all about relationship building. The stronger relationships you can build, the better you are going to be in the long run. If you look at the graph on the side, you can see 8 to 12% of your business actually comes from the strongest ties you're building. So if you can build stronger ties, you're going to be receiving even more business from them. And this is also all about going from quoting rate to really becoming a mortgage advisor. So you're going to really focus on not only building business with your borrowers and your realtors, but other referral sources. So that's what we're going to talk about. Let's begin by talking about the borrower. So the borrower, we're going to talk about building that annual mortgage review total cost analysis. We're going to talk about the importance of email as well as follow-up phone calls and really focusing on building a client for life mentality. So when your client does think about refinancing or doing anything or even referring people, your name is the one that they think about. In the strategy of doing an annual mortgage review, there are several different things that you may end up focusing on. First off, restructuring a loan because they're in a bad scenario. This may be a second loan that has high interest rates or possibly even a loan with MI. If they had a poor credit score when you initially closed them, to be able to go back in and talk to them about how now they may get a better loan because of their credit score. Home improvement loans, wrapping that up. Cash out, especially debt consolidation with interest rates going up. Debt consolidation is a great one to focus on because now you're going to be able to take away from the fact that the interest rate is higher that they're refinancing into and focus on the fact that the interest rate is lower than that revolving credit. Lowering the interest rate if there is that case. And also there's going to be a lot of cases where there's no real benefit, but I'm going to show you how to do an annual mortgage review for those people as well. We have been working hand in hand with Rick Shear to come up with a process, and he has been working this process since December. So come December, he started working it, and he's finding that he is closing 22 to 36% of these people that he's using this process with. What he does is he has a standard email built that he attaches the person's name to, and he attaches either Calendarly, Schedule One, any app where your client can self-click in order for them to establish an appointment with you. Once they do establish that appointment, then you'll move forward and do the annual mortgage review. You do not actually build a total cost analysis in this way until you have that appointment. So you're not wasting any time. Once you go through this, if you do not hear back from them, if they do not schedule that appointment, the next thing you're going to do is a phone call. But you are not going to actually pick up the phone and call each person. He uses what is called Slide Dial. Slide Dial is amazing. You're able to upload your phone numbers for all of the people you wanted to do the annual mortgage review for. And once you upload those phone numbers, it will call those people. It will not directly go to them, but directly be led into their voicemail and leave a voicemail. So you're going to have one standard voicemail for everyone. It's simply going to say, hey, I sent you over an email, wanted to make sure that you didn't miss it. It's going towards the annual mortgage review. In there, you're able to set your own time that's convenient for you and your family. So please find that email and click on it. If you did not receive the email, call this person. They will make sure to send it back over to you. The reason why it's important, you'll add that in there, and then you'll thank them for their business. And then, of course, you probably are still going to have some people that do not respond, and it's expected. You are going to do one more follow-up email. So you're hitting them 3 times. That last email is simply going to say, hey, it's time for your annual mortgage review. Click here to get started. So very simple steps, 3 steps that you're going to be going through with each client. Now, the next thing that we want to talk about is realtors. With the realtors, you want to call anyone that you've done past business with. These are the ones that you're going to work with initially if you haven't established relationships. So if you have closed a loan with a realtor, you just want to call them and say, hey, I have a new process that I'm implementing. I want to show you the process because I plan on including you in it. So more likely, realtors going to be saying yes, because most realtors are also not working their past book of business. So when you do meet them, you're going to let them know about the annual mortgage review, show them a sample. You're going to tell them that you plan on asking what was the current home value, because you're going to include in that annual mortgage review that you guys work together, the realtor as well as yourself, in order to come up with the total. And then you're going to ask when they last spoke to the client. Reason you want to ask when they last spoke to the client is you are trying to gauge, are they working their past book of business? Because if they're not, this may be an opportunity for you later on. And that opportunity might be to assist that realtor to work their own past book of business through annual mortgage reviews. But there is another type of annual mortgage review that you can also volunteer to help that realtor with. And that's by doing rent versus own presentations. A lot of realtors are also leasees. So they have the ability to come in and do some property management. And when they do, every year when those leases come due, you can reach out to them month 11, send a rent versus own analysis, and show their clients the benefit of buying versus continuing to rent. The next group of people that you're going to reach out to are those other referral sources. So investors and tax accountants are probably the ones that you focus on most. And you're going to reach out, again, share the mortgage coach, share your annual mortgage review, what you're doing, explain the process to them. And then if they are in the investing or tax accounting business, you're going to share the reinvestment section, and you're going to show them how you can implement that into the annual mortgage review. You're also going to talk about what type of client is their ideal client. The reason you want to get which client is an ideal client is you want to make sure that when you do give them referrals, you're matching the client and the referee to make it a perfect match. You want to make sure that they can meet your client's needs. So what are you going to do in that annual mortgage review? Few things you're going to do. First, you're going to have a conversation with the client. That conversation is going to go a little bit like this. How's the house? how's your family doing? Talk to me about your family. How about your grandparents? Tell me a little bit about your grandparents and the children. The reason for this conversation is to first establish that solid relationship. You want to build on relationships. Talking about family is one of the easiest ways to build a relationship with a client. The second thing is, how's the house? The reason you want to ask how is the house, because you want to dig out, do they need anything fixed up? Is this home meeting their needs, or is it not meeting their needs at all and they need to purchase? Where is their mindset when it comes to this house? Now you're going to have a mortgage conversation, and you might be thinking, I already know about the mortgage because I closed the mortgage. Reality is 10 to 16% of those people in your past pipeline are actually doing something with their loan every year, whether it's refinancing, cash out, buying a new house, buying investment property. So you want to make sure you have that same information that you had when you closed the loan. So here you're going to ask the basic questions. You know what? I just want to verify what I currently have on my books with what you have. So you closed your loan this day, you still have this interest rate, you still have MI on the loan. But I also wanted to let you know that me and your realtor, so-and-so, we did meet and we talked about your property. And right now, this is how much equity you possibly have in your property. So we can go through and talk about the equity. And then you're going to move on to the next section. It's going to be a pretty brief conversation because you don't want to go in depth until after you've built that annual mortgage review. The next one is to rate your advisor. So you're going to simply ask the client, I want to talk to you about a few different people that you should have in your life right now. If you can just tell me how you feel about them, 1 being worst, 10 being the best, are they meeting your needs? So tell me about your financial planner, CPA, estate planner, and insurance. Now you're going to get all kinds of different conversations here. You might have their family member. You might have, you know what, I have my CPA because it's the same CPA that my parents used, but he's really only a 4. More likely 75% of the time you're going to get, I don't have an estate planner. And then the insurance agent, you want to make sure first they have their insurance, auto and home on the same plan. And then second, how is that insurance agent meeting your needs? Now, when you come back after you get those responses, you're going to come back and you're going to go, okay, so we talked about your financial advisor. That's your Uncle Bob. Great. I understand about doing business with family. Sometimes it's great. Sometimes it's not so great. But let's move on to your CPA. You said they were only a 4. Why were they a 4? First, pull out what's the issue. Then you're going to say, you know what? I have a 10. I have someone who is fabulous at that. It will not be an issue. Let me give your information over to them. So then you can move on. Estate planner. You said you didn't have an estate planner. Well, your home is probably your largest asset. And if something was to happen to you, we want to make sure that your home is not something your family has to fight for in court. So let's meet you, or let's introduce you to my estate planner that I think is going to work. There's no obligation, but it will make you feel more comfortable at least knowing your options. And finally, the insurance agent. Same thing. You have a 6. They're not doing this for you. I have a 10. This is only to help you pull out those referrals. He said that the majority of the time, he's actually able to pull out all 4 of them. The ones that he's, again, really careful about is family. If they are family, really don't go into family too much. And then, like I said, estate planners, most of the time they don't even have an estate planner. So let's go through why I go ahead and pull up my mortgage coach. I do want to ask you a few questions just to gauge where you're at. So first one, how many families do you have in your past book of business? So if you can go in, let me know how many families you have in that past book of business. I do wait till 70% of people have voted. So the faster you vote, the quicker we can get through this. In this past book of business is gold for you. I have about 6% of you that actually have more than 1,000 people in that past book of business. As I said before, 10 to 16% of them are doing something every single year. So if you are not working that past book of business, you can see based on how many people you have in your past book of business, how many people that you're possibly losing each year because you've already established a relationship with this client. So let's go ahead and close that one. I will show you guys the results on there. So again, 6% over 1,000, a large percent of you 500 to 1,000, and we have less than 100, 18%, which is fabulous because we always need that new blood in the industry. That's my guess, is these are newer agents. And then let's go into one other question. Really simply, are you working that past book of business? So let me go ahead and close that one off. 69% of you are kinda, 18% yes, great job to you guys, and then 18% not at all. So remember, this is a golden book of business here because you've established that warm market. What we're going to do is we are going to go through and build 2 different presentations. They're going to be called master templates. These are going to be templates that you can easily copy and eliminate a lot of keystrokes when you're entering in your client. So if you are working alongside of me, bring up your mortgage coach, downsize me because I'll talk you through it. And once you do have your mortgage coach up and you're ready to go forward, raise your hand. If you're not going to work alongside of me, that's okay too. Just raise your hand so I know I can move forward. So I'll give everyone a minute to get your mortgage coach up. Leave your hand up in the air. When you do raise your hand, I'll put them all down at once, and this way I can see everyone on the call because there's quite a few of you. So we're going to build 2 different master templates. That first master template we're going to build is a no benefit refinance. And that second master template we're going to build is the basic rate and term refinance. So both of them are ones that you will heavily use for that annual mortgage review. Again, raise your hand when you're ready for me to move forward. I have only about 1/3 of you with your hands up in the air. Leave them up in the air once you raise it, and that way I know I can move forward. Let me get a few more hands raised and we'll go ahead and get started. Okay, let's go ahead and get started. I'm going to put everyone's hands down. So what you're going to do is once you log into Mortgage Coach, you're going to click on New Client. Once you're in New Client, simply make it a marketing piece. Here we're going to type the asterisk, and the asterisk allows when you do a search for this to come to the very top of the list. That's why it's important. Then we're going to put AMR dash and no benefit. That is the only thing you need on this page. So asterisk AMR dash no benefit. Once you have that in there, go ahead and advance forward. And if I'm moving too fast, let me know by raising your hand just to let me know I'm moving too fast. I'll slow down a little bit for you. But it's very simple, basic information we're putting in. The next thing we're going to click on is just Other for your benefit. Now we're going to move forward. Here, property value purchase price. There's 2 different scenarios here. Either you're in an area like me, I'm in Southern California. My first-time home buyers are probably around $400,000. My other loans are over $1 million sometimes. So I have a wide span of different values. I'm going to leave this blank. However, if I lived in Kansas where my mom lives, Her average home right there is about 120. So I would put 120 for the area that she lives in if I worked in that area. So if you live in an area where the home values are pretty standard, put in a standard number. If you live in an area where it fluctuates a lot, leave it blank. It's the only thing we're going to fill in or not fill in. Advance forward, we're only going to fill in the term. We know the average American is in a 30-year loan, whether it's fixed, ARM, most people have a 30-year. Now we're going to go place our mouse down on products and click in products. We're going to build two simple products here. The first one is a principal reduction. So I'm just typing principal reduce. That's all I'm placing on this product, nothing else. We'll advance forward twice. And at the bottom where it says add another product, clicking down there and adding our second product. And this is going to be investment. Again, nothing else there. Now we're going to go into our analysis window. So place your mouse down on analysis and click on there. Here we're going to set it up for, again, your standard client. So based on your area, property appreciation. Short-term months, I'd leave it at 60. Long-term, I'm going to place it 10. Reason why is 10 is the new 7. So everyone was doing something every 10 or 7 years. Now it's every 10 years. And then down at the bottom, total net worth is what I'm going to show because I am doing an investment, so I want to show the difference it's going to make in their value. That is all I'm placing in this presentation. We're going to go back up now, click on home. Now I'm going to show you how to use the presentation. So when you click into view all you need to do is type in that asterisk and click on search. Now I'll have several come up here. You should only have one in here at this time. You can see this is the one I just did. You're going to click on that single product. Then down on the right-hand side towards the bottom where it says copy analysis, click on copy analysis. You want to click it to a new client and click on OK. From here, you're going to put in your client's name. If you're working with a realtor, add the realtor's information and their email address. And then for friendly name, annual mortgage review and the year. Now you're just going to go to assumptions. Assumptions you can place in that property value. I'm going to say 550. Advance forward. First payment date. Now remember, this is one we can't do anything with, so more likely they don't have any more equity than when they first bought it, or their interest rate's really low, whatever it is. The original loan balance, not the amount they purchased the home for, but how much was that initial loan? I'm going to say it was $425. Their interest rate, I'm going to say, was 3 3/4. It was a 30-year fixed. It will automatically update an amount for me. Then I'm going to click this auto update balance. This is going to allow me, when I come into it for next year, it's going to have this amount all correct based on the scenario we've already done. Now advancing forward, you want the hard numbers. You don't want to do percentages here for the hazard amount and the property tax. If they do have mortgage insurance, you can add that mortgage insurance. Now we're going to go straight over to our product into that principal reduction. We're going to simply copy from that current loan scenario and click on OK. That's all we're doing here. Remember, we are going to just make it match that current loan. So we will have 3 loans over here exactly the same. Put your mouse back on products, go into investment, and again, simply copy from that current loan scenario. Now we're going to go into our analysis window, and this is where we start playing with that reinvestment strategy. Go into the adjust reinvestment strategy, and I'm just going to use $150 for today's example. So I will go in principal reduction. I'm going to add $150 here. My referral source that I have for my investment, I'm going to talk to them. What is your average rate of return? This is going to be put on a worksheet so I can refer to it whenever I need to. I'm going to say he said it's 5.83. Then I'm going to put that 150 down here. So now I've invested 150 in the principal reduction, 150 in the investment at the lower bottom. You can see which ones they are by reading over on the left-hand side. Simply clicking on OK. Everything else is set up in this window. I'm going to go right into my presentation preview window. I want to make sure I'm notified as well as my partner's notified. Add my quote date. Even though I'm not refinancing, I still want to protect me just in case, and click on preview. In this window, there's only a couple of things that you want to highlight. You can highlight that principal reduction payment here, but when you go into the more information, you also want to highlight your investment payment. When you go down here, they can see exactly how it's broke out now. We're going to exit off of there, and we're going to talk about the savings over 60 months. This is that extra savings in interest that you're reflecting. So they're going to save an extra $882 in interest. However, they're going to build more equity by doing this by looking into that bottom right-hand window, the net worth in 10 years. That's where you're going to be able to talk to them about their financial impact that they're going to have. So if you have any questions about the no benefit, go ahead and drop them down in that question box and we'll come back to it. But let's go in and build that second scenario because we only have a few minutes and luckily these are fast. We're going to click on that new client again. Once you go into your new client, place it on marketing. Again, asterisk AMR, and this one is rate and term. We're going to go in our goals, reduce payment. Assumption area. The property value, this time I'm going to put 450 in there just to show you how it reflects on them. I'm going to move to the next window and put my 360 days or months right there. And then I'm going to go into my products. And here you have a couple of choices. I know many people don't use that 20-year fixed. First one I'm going to put is 30-year fixed. Advance forward twice. Add that next product. And if you do not use the 20-year fixed, don't include the 20-year fixed. Because I know for a lot of you, that 20-year fixed interest rate is the same as the 30. So if that's the case, don't add that 20-year fixed. Advance forward twice. Add the third product, 15-year fixed. And then we're going to advance forward twice. We're going to add one more loan scenario to it. Cash out. You're going to go into your analysis window. Only thing I would adjust here is I would make it a 10-year loan scenario. And that one is complete. So now you have that second template. Let's go in to see how to use that second template. Again, in the view all, type in your asterisk, click on search. Now you should have two of them. Click on that arrow for that rate and term. That's going to open up that product so you can click on the product itself, copy your analysis to your new client, and open it up. Once it's open, start typing in the information. Again, placing referral information if it does pertain, AMR 2018, going right into your assumptions. I already have the 450. Now, if it's different, I can easily change it. I'm going to assume it is the 450,000. I'm going to come in, add my payment date. I'm going to say 2009. We know rates were higher then, so let's make it a 2009. I'm going to say they bought it for 400. Interest rate was 4.875. Again, clicking the Add Auto Update. Now moving forward, adding my hazard insurance as well as my property tax. Now I'm going to go into my products themselves. Once you're in your products, you're going to do 2 steps. First step, copy from the current loan scenario and click on OK. This brings over your property tax and hazard insurance. Second thing you're going to click on is it a refinance? Yes. Now you can go down and adjust everything. I'm going to say they can get a 4.5 today. You're going to add in your closing cost details. Hopefully you have created templates in here. So you'll lay your template down. If you have not created templates and you're with a enterprise, please send a message over to support@mortgagecoach.com and they can tell you what they need. Going through all of here, I'll verify the correctness. Once it is correct, apply it to the loan, add my prepaid days of interest, and I'll move forward. Now all I need to do is add in my reserves, 2, collect my 12 months, and 4. But now I'm going to click the back button because I want to go back into my closing cost details to add everything to the loan. So add to the loan button right here. I did not do that before because the grayed out items on here, if I would have added it the first time, were not included in this window. So if you find cash to close coming in, always check to make sure all of them are loaded in and added to the loan in this window. Apply it to the loan, add your prepaid days of interest to the loan, and now we can move to that 20-year fixed. Now it becomes really easy. Once you're on that 20-year fix, you're simply going to copy that 30-year loan, click on OK, update the interest rate, update the term. That's the only thing more likely you need to do. If there is something different, maybe you have to put points in there or lender credit, you can add that. Next one is that 15-year. Again, copying it from the closest loan is that 20-year fix, clicking on OK. We're going to update that interest rate and update the term. And then the last one is our cash out scenario. Now, cash out, you have choices here. Let's say you talk to the client and the client is like, you know what, financially we're doing really good and we want to make sure we pay this house off in 11 years. So that's our goal, is to pay it off in 11 years. So we're going to look at that 15-year fixed. I'm going to then copy it from that 15-year fixed if that's the case. If you talk to the client and they're like, you know what, we need that extra money right now to fix up the house, but we need to keep our payment under that current payment, I'm going to copy from that 30-year. So this is about having that conversation with the client. So I'm going to go ahead and copy it from the 30-year. Click on OK. Now I'm going to add in the amount of cash that they want. Maybe they need an extra $20,000. I'm going to place it right here by making that 3. Everything else more likely will stay the same unless their loan to value is above that 80%. So make sure you're watching that percentage on that bottom. If they're paying off debt, revolving credit cards or something, add it into the closing cost. Add in a custom fee. Let's put revolving credit. Add it to your prepaid defaults and click on OK. And then I can put that $20,000 right here. But we want to make sure that this amount is not added to the loan. And you will get a copy of this emailed to you about 24 hours afterwards. So if you miss something, it's all right. Now we're going to apply that to the loan. And now I can go right into my analysis window. Analysis window is always a great place to check, did I do everything right? Does everything look okay? So when I go in here, I'll look short-term savings. These two are going to save them. This one's not, of course, because they're pulling that extra cash out. So that's why it's reflecting not saving them money. They are coming in and making lower payments here, here, and here. That 15 years, an extra 281 months. And then the long-term interest in MI, my suggestion, click down here and see which one's going to make sense for your client based on their goals. So based on your goals, maybe they want to make sure they're applying the most towards the principal paid. Now I can go into the presentation, but I'm going to click on Select Report because I want to show you one more aspect. And Craig, if you have a question, I'll come to you right after I show the rest of this. So if you do not want to show one of these products, if one of these products you can if you want to add to the title. So Craig's question is, up here, why didn't I add the amount? If you want to go in here and type in 20K up here, you can type in that 20K. It is completely up to you how you define it. So you could also put 20K 30-year fix. Yes, Gary, you will get a copy of the recording about 24 hours, and it is very fast just because I want to make sure I get through. Everyone has different learning speeds, so we're trying to make sure we meet the needs of everyone, and that recording helps a lot. So now I'm going to go into presentation, select report. If I don't want to show that cash out, I can simply remove it. If I don't want to show that 20-year fixed, I can simply remove it. Even though you have them all built into the presentation, it does not mean you need to show them all to your client. So even though it's built into your template, you don't even have to fill out the ones that are not relevant to the client. You just turn them on or off at the end of the presentation to show whichever ones you know will meet your client's needs. I'm going to leave that 30-year off just so you guys can see. Click in that preview. Again, notify you, add your quote date, click on preview. Once you go into your preview, you're going to highlight a few things. Because this is rate and term, we want to highlight those interest rates. We want to highlight our payment amount. You can see cash out, mine is all reflecting 0 because I put that extra $20,000 towards the credit cards. Now, if I did not do that, I'm going to go in and show you what it looks like if they're getting cash in hand. I'm just going to go in, remove that cash amount from this closing cost detail sheet. In order for it to trigger that I saved it, I need to click forward. Now it will update a -20 showing that my client is getting cash back. So you can make sure that you're getting the exact cash back that you need. Now when you go through, you'll go into that more information. Only check the things that are really different on each loan. Property tax, hazard insurance, those stay the same. Don't highlight those. You may highlight that P&I payment, the total payment. Closing costs, more likely, again, are identical except for that cash out. Here in this window, based on what your clients are looking at, you can say, look, we can get you $20,000, put you back into a 30-year, but your payment is still $358 less. So here in this case, you can even show them if they stay at the same level payment by going into the refinance scenario and applying that $358 as a principal reduction. Savings over 60 months, they are going to save money even though they're refinancing. And then principal paid is what we're showing. This 15 is applying the most towards the principal. So that is the basis. The other thing you always want to make sure you're adding is a video. And I'm just going to quickly show you how to record a video on the phone. So when you go into the phone, and we typically suggest the phone because the phone has better audio and video, especially if you're on a laptop. We're going to click on Client. I'm going to click into Ryan's presentation and total cost analysis. And now I'm going to click on where it says video. Once I click into video, I'll click on camera, and that brings up the camera right there. To start the recording, just click the button. The timer's up here. Keep it under 1.5 minutes, 2 minutes max. Anything over 2 minutes, your clients are checking out. If you have natural lighting, a window is always best. Face that window when you're doing the recording. Make sure there's nothing distracting going on behind you. If you make a little stumble in your words or what you're talking about, don't worry about it. They know you're not a professional, and that only makes you more human. If you talk with your hands like I do, be natural. Talk with your hands. It's okay. I also have a lot of facial expressions that I do. So you want to be as much you as possible when you're doing it. Presentation-wise, only briefly talk about the information that you talked about when you went and talked to them. So you may say, you know what, when we talked about you possibly needing some extra money to pull out for your home in order to do some repairs. I'm showing you a $20,000 cash out on that extra product there. So look into the more information, dive into those numbers. I'm going to call you so we can go over it together. I will give you a call Thursday at 1:30. Always give them that direction, what's going to happen next, so you're following up. Follow-up is very important in this process. Once you're done clicking that little button at the bottom, click on Use Video, and it will upload the video onto the phone. Once your video is uploaded, you will click on the word Done, and you can even send it right to your client right from your phone. Simply clicking on Done, clicking on them, total cost analysis, upper right-hand corner. This is your send button. If you are on an Android, it is the less than symbol with the 3 dots. Simply clicking there allows you to send it to your client. So that is the basis of the annual mortgage review. A lot of times I get questions, where do I start? Start with your clients that are coming up to their 1-year anniversary. So those are the first, they're the freshest, they are your warmest market. So start with your warmest market and then move back. Do 1 year at a time and just keep moving back until you've completed all of your annual mortgage reviews. And then you can start fresh from now moving forward after you've completed them. So I do want to give you the opportunity now. If you are good, you're welcome to drop off. I will not feel bad. But if you do have questions, stick around. Feel free to ask me questions. You have about 20 minutes left that you can ask questions on. Looks like there are no questions. If you do have questions, we are always here available for you. You can go to the main page that you are on and simply click down on the support button, type in your problem, all the annual mortgage review stuff will come up. And more likely, we are on live chat, or it will say contact us. Send over to our support team. They are fabulous, and they're there to help you out. So thanks again. I hope you all have a great and powerful 2018. Bye-bye.